All right, guys, welcome back. Believe it or not, this is the second time we're shooting this because I didn't plug the mics in the right place. So we double, triple checked it this time, and I think we're ready to go back to the broadcast. We're talking about the 4 to 5 different things you can do with your money during this recession if you don't want to put it in real estate or if you have it like in the mattress somewhere where it's not returning any kind of investment. So we're here with Kavi with Merrill Lynch, and he's going to go over a few different things.
Kavi Fulena, like Angel said, I'm at Merrill Lynch. Basically, my team run CFO essentially for individuals and corporations. We handle every financial product out there, so we've been watching this environment for some time.
Who are like some of your clients that you guys work with mainly?
So I can't give you any specific names for confidentiality reasons.
Of course.
So they're going to be different industries, individuals, corporations, a lot of athletes, a lot of entertainment. That's just a function of being based in Los Angeles, but
Right.
like I said, we deal with a lot of institutions as well in different capacities, from your startups raising capital to Fortune 500 companies.
So they kind of come to you and said, hey, we have, just say $1 million. Like, what can you do with it?
That's one conversation we could potentially have. What do we do with our operational cash that, comes in and goes out on an ongoing basis? That's a common one with businesses. And if we were to tell them, hey, we could actually generate quite a bit of income on that, that cash that's constantly in rotation, it's essentially free money.
Yeah.
We can do the same thing for individuals. The question you asked, hey, I got $1 million, what should I do with it right now, is a more involved question. It's going to be very subjective based on the individual, and I'd be wary of anybody who gave you advice right off the cuff with, hey, I've got $1 million, you should probably put it here. So I think all the more reason to do your due diligence and make decisions that are tailored custom to the individual or corporation as opposed to something that, everybody and their mom and pop are getting involved in.
Like what you just said versus an individual who just happens to have money in a bank account, not receiving any interest, versus someone who's a little bit more, say, sophisticated, where they need hey, we get X amount coming in, we can invest this much, and we got more coming in next month.
Absolutely, and I mean, right now, there are a ton of opportunities. This is a really interesting environment. Some would say this is kind of what makes our environment more interesting. For the most part, past 10 years, you could throw a dart at a dartboard and make money. It wasn't very hard. But right now...
it's kind of like in real estate, I mean.
Exactly. Yeah. Right now, you got to get a little more creative, and there are plenty of areas to make money right now. You just got to know where to look.
So let's just start with the average person, right? They have some money to invest.
So right off the bat, let's just acknowledge the elephant in the room right now. Inflation. Inflation is huge. Keeping your money in a bank account, earning nothing. I mean, at the height of it last June, inflation was about 9%. So you're losing 9% of your purchasing power.
9% a year on your money.
By just keeping it, in a checking account. Our solution to that is we're paying pretty healthy 4% on cash deposits right now. It's basically the same thing as a savings account. Risk-free, same-day liquidity. There's no minimum holding period.
You can pull your money out. It's basically like a checking account.
Exactly.
I can put my money in tomorrow, and I can pull it out a week from tomorrow.
So yeah, baseline, I'd say if you're not earning a minimum 4% on your cash right now, you should be looking to do that. Now we can juice those returns up. Money markets right now paying anywhere from 4 to, I'd say, close to about 5%. Same kind of deal. Risk-free. There's no prolonged, liquidity requirement. You can pull them out any day. Now, if you have more time, you can juice those returns even higher.
So this is going to be like a different vehicle where you got to leave the money in longer, or?
So really, you don't have to leave it in longer. It's just better practice to avoid any fluctuations or any, short-term volatility. So, you say you have, 6 months plus, we could probably get those returns, closer to 6 to 8%, and it's going to be within that realm. Usually, what we end up doing is we do a ladder approach or a combination strategy where we have very liquid money that's getting the baseline 4%, and then the longer term money we can juice up a higher return using other what's known as fixed income vehicles. And then this is where it gets custom to the individual. We're going to look at the income bracket they're in. What's the tax bracket? because then maybe something that's tax advantage works. Muni bonds are paying, the highest rates I've ever seen, close to 4.5%, and that's completely tax free.
What's a uni bond for most people that don't know?
So muni bonds are basically bonds issued by the government, funding schools, building roads, building airports. They are essentially the government's paying a yield on them to incentivize people to buy them. You'll see exactly what the bond invests in prior to purchasing it. Right now, when I say you're getting, 4 to 5% tax-free, that means the tax equivalent yield is closer to 9-10%, especially when you look at a person's tax bracket. Say you make over, 500 grand a year, you're paying, close to, over 40% in capital gains on a lot of things.
The income you make from this investment with the uni bonds, it's completely tax-free.
Correct.
The first one that you talked about was the...
So that would be known as the preferred deposit vehicle. That really is, I'd say, one of the best products out there right now. I'm not going to say it's a long-term product, but I'd say it's definitely one to take advantage of in the short term.
What's like the minimum for something like that?
100,000.
Okay, 100,000.
The nice thing about that too is it's 100,000 to do the initial purchase. After that, you can withdraw. You can drain it down to $1,000 if you want, and buy back in if you'd like. They just need the 100,000 to satisfy the initial purchase requirement.
And then the mini bonds, how long does somebody need to leave their money in there for?
I'd say if you have, 3 to 6 months minimum. And really that's going to make sense for someone who is very tax sensitive. Every individual differs. Say you have an individual who derives a lot of their income from their corporation and pays himself a salary out of that, right? Keep the salary low to keep the income tax low. Now we could look at, potentially a high yield bond type of option that is taxable, but if it's paying 6 or 7%, we really need to look at the tax rate that difference in return is going to be taxed at and whether or not it makes sense. And really this starts to affect individuals when they have quite a lot of capital invested. That difference could be tens of thousands of dollars, so it's worth looking at. And we'll make sure we're doing whatever needs to be done to make sure that individual's collecting the most money as well as the least amount of tax liability at the end of the year. So there are other products as well that make sense in this type of environment.
Okay.
We have structured products. Those basically use what are known as options, and we can essentially create a custom strategy that works well in a very volatile market. You can play either side of a stock. You can play the side where you think the stock will go up. You can play the other side where you think it might go down. This is what these prepackaged products do, and they've been extremely successful in environments like this because we can essentially add buffers, downside protection, things like that.
So when you mention options, I mean, the first thing I think of when I think of options is like risk. It sounds super risky.
Absolutely. I don't blame you for thinking that. People can absolutely blow themselves up using options. That's why we have these structured products that basically have prepackaged options and the strategy already set up out the gate. This is where we can basically mitigate a lot of the risk you might have. Essentially, I mean, I'll go right out and say it, if you don't know what you're doing in options, you could drain your account to past zero. So what's nice with these things is, obviously we err on the side of caution at our firm. However, these options are nice in this type of environment because we can add downside protection. For example, one of the products out there might have a 10% buffer of downside risk baked in. What that means is, say the S&P 500, the largest public market out there, goes down 10%, your investment goes down zero because you have that 10% downside buffer baked in. If the market, the S&P, goes down 15%, you're only down 5%. So actually these options are kind of designed to form more of a defensive strategy. This forms one approach of your whole strategy.
So how do you have a 10% buffer baked in?
Now we can really get into the weeds on this. So basically, this would be by using multiple types of options within the product. You'd have a combination of both call and put options baked in. So you can essentially guarantee that if the market goes down, you're making money because you're playing the other side of the coin.
So you're kind of hitting the arbitrage between the upside and downside, basically.
Exactly.
Okay.
Yeah, and I mean, honestly, the other option too for our qualified and accredited investors out there would be alternative investments, your hedge funds, private equity, real assets. Those strategies have been extremely successful in environments like the ones we find ourselves in right now. We're highly volatile. This is where private investment does really well. You're not really subject to the overall economic environment. Not going to make sense for every investor out there, but looking at the target demographic you work with, I think that's something that would make sense.
So when you mentioned hedge funds, like what are the minimums on that, and how long does somebody need to leave their money in there for in a hedge fund?
So hedge funds are going to vary. There's definitely a lockup period involved with most hedge funds. You know, generally speaking, you want to have between a $2 to $5 million net worth to gain access to a lot of these vehicles. They want to basically see the net worth is there. That doesn't mean you need to put in $3 million right off the bat. We just want to satisfy certain criteria.
So hedge funds can have a lockup period of 3 years.
Hedge funds can, private equity can too. That's not to say all of them do. Some of them don't have that at all. Some of them are somewhat more liquid. This really makes sense more for long-term capital. You know, it's one of those things, if you go in having done your due diligence and having, you know, looked at the historical track record and understand why you want to own this thing in the current environment, you should be fine. That's why, you know, we try to research these investments and, you know, only use things that have a proven track record that we know.
All right, guys, that was a lot of stuff that Kavi just went over. If you want more details on it, I'm going to put his information below. Feel free to hit him up at any time. Kavi, did you have anything else to say to our audience out there?
Yeah, I mean, honestly, right now, don't be scared. We see these reset periods every 10 years or so. These are loaded with opportunities right now. This is where a lot of real money is made. Take advantage of it. Talk to your finance professional. There are some good opportunities out there. Make sure you're on top of it.
And the wise words of Warren Buffett is to be
greedy when others are fearful.
So be greedy, guys. Thanks for watching. Please like and subscribe and hit the comments if you have any questions for any of us.
Sounds good. Thanks.
All right, guys.